Hey everyone, welcome back to MarketSnap. TU has one of the best dividend stories in the market right now. That's exactly what makes it dangerous. We're skipping the pitch deck and running the numbers, financials, cash flow, and a MarketSnap valuation pass to see if the story matches the spreadsheet. Here's the setup. Telus is down over 40% in the last year. The stock has fallen more than 20% in just the last 3 months, and over 5 years, it's down nearly 60%. We're not looking at a stock in a dip, we're looking at a stock in the middle of a full-blown reset. The dividend yield has blown past 11%. That's not a sign of health. That's a market screaming that it doesn't believe the payout is sustainable. So what exactly is Telus? It's one of Canada's big 3 telecoms, headquartered in Vancouver. They operate wireless and wireline networks across Canada, and they've been pushing hard into health technology and digital services. They've got over 110,000 employees and a market cap right around $15 billion. This is not a speculative startup. This is a massive, mature infrastructure business that has hit a wall. Let's talk about the revenue picture, because this is where the story gets complicated. In 2025, Telus pulled in about $20.3 billion in revenue. That's up only about 1% from the year before. And here's the thing. The gross margin on that revenue is actually pretty solid, sitting around 39%. But revenue growth has essentially stalled. For a company carrying this much debt, flat revenue is a problem. You can't grow your way out of trouble when you're not growing. Now let's get into the earnings, because this is where the real tension lives. Full year 2025 earnings per share came in at 73 cents. That's up from 67 cents in 2024, so there is some progress. But here's the catch. Back in 2021 and 2022, Telus was earning over $1 per share. The company's profitability has been cut by more than a third from its peak, and the most recent quarter, Q1 of 2026, came in at 17 cents per share, which matched expectations, but was down from 18 cents a year ago. The trend is stabilizing, but it's stabilizing at a much lower level than shareholders are used to. Management on the latest earnings call was pretty direct about the situation. They highlighted continued customer additions and stable profitability, which is good, but they also leaned heavily on cost controls, asset monetization, and growth in health and digital services. The key phrase from the call was financial discipline. When a telecom CEO starts talking about financial discipline, what they're really saying is, we can't rely on revenue growth anymore. We have to cut our way to better numbers. Let's dig into the balance sheet, because this is the heart of the Telus problem. The company has over $51 billion in enterprise value. Total debt sits around $43 billion against equity of about $15 billion. That's a debt-to-equity ratio of nearly 2.4 to 1. For a telecom, some leverage is normal. This is beyond normal. The current ratio is under 0.7, which means they don't have enough short-term assets to cover short-term liabilities, and the return on equity is negative 6.5%. That's not a typo. The company is destroying shareholder value at the equity level right now. The cash flow story is actually a little more encouraging. Free cash flow in 2025 came in at about $2.35 billion, up from $1.46 billion in 2024. That's a solid improvement, driven by reduced capital expenditures. Operating cash flow was stable at around $4.9 billion. So the company is generating cash. The question is whether that cash is enough to service the debt and support the dividend. Let's run the SWOT analysis. Strengths. Telus has a dominant position in Canadian telecom, a massive infrastructure moat, and free cash flow is improving. They've also got a growing health services business that has real long-term potential. Weaknesses. The leverage is severe. Revenue growth has stalled, and the return on equity is negative. Opportunities. The dividend reset frees up billions for debt reduction, and management is targeting double-digit free cash flow growth through 2028. The health and AI-related businesses could be meaningful growth drivers. Threats. Competition is intense. Interest rates keep debt costs high, and there's real risk that the dividend gets cut further or eliminated entirely. The market is already pricing in a lot of bad news. The question is whether there's more to come. Look at the chart and you'll see the pain. The stock is down 41% over the past year. It's down 29% over 6 months. And over 5 years, it's lost nearly 58% of its value. The stock hit around $10 and change recently, and it's trading at levels not seen in years. The 52-week range tells the story. This thing has been in free fall. The one bright spot is that the rate of decline may be slowing, but slowing decline is not the same as recovery. So what's the stock actually worth? We ran the numbers through the MarketSnap valuation model, and we used a forward price-to-earnings approach as the primary engine, with a discounted cash flow model as the supporting check. This approach fits because Telus has positive analyst estimates and a positive free cash flow history. It's a mature compounder, not a speculative growth story. The model puts fair value somewhere in the neighborhood of $11. The stock is trading right around $10 and change. So we're talking about maybe 7 or 8% upside to our rough fair value estimate. Basically, the stock is trading right at what the model suggests it's worth. That's not a screaming bargain. That's a fair price for a company with serious execution risk. What drives this valuation? 3 things. First, the forward PE multiple. The model is applying a multiple of around 23 times forward earnings, which reflects the market's view of Telus as a mature or low-growth, high-debt telecom. Second, free cash flow conversion. The model assumes free cash flow converts at around 110% of net income initially, declining to 100% as capital expenditures normalize. Third, the discount rate. We're using 10.5%, which is higher than the standard 9%, because this company carries meaningful risk. And here's the important part. Change any of these assumptions, and the fair value moves a lot. If you disagree with our inputs, plug in your own growth or discount rate assumptions on our intrinsic value calculator at MarketSnap.com. You can run your own valuation and see how the number shifts. Here's my take. Telus is a turnaround story, but it's a turnaround story that's still in the early innings. The dividend cut, which freed up roughly $2.7 billion through 2028, was the right move. It was painful, but it was necessary. The company is now focused on deleveraging, and management is targeting double-digit free cash flow growth. If they hit those targets, this stock could re-rate significantly. If they don't, the dividend could be cut again, and the stock could keep sliding. If you put $10,000 into Telus today, the model suggests it could be worth around $11,000 in 5 years. That's roughly 1% annualized growth. That's not a home run. That's barely keeping pace with inflation. The upside here is not in the current valuation. It's in the potential for the company to execute on its turnaround plan and earn a higher multiple down the road. The key things to watch: free cash flow growth, debt reduction progress, and any signs that the dividend is stable. The bull case is that Telus has already passed peak pessimism and the infrastructure assets will eventually win. The bear case is that this is a value trap with too much leverage and no growth. I lean toward cautious optimism, but this is not a stock for investors who need certainty. What do you think about TU? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes. from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.